For generations, the formula for a successful life was passed down as an absolute law. Study hard, get good grades, secure a safe job, a pension, and buy a house. Many doctors, lawyers, and corporate executives now follow that path to its conclusion, only to find themselves living paycheck to paycheck. Despite record salaries, they remain weighed down by mortgages and high-interest consumer debt. Chasing a higher salary through longer hours or promotions often creates a mathematical wall. Because of the progressive tax system, a raise pushes the earner into a higher bracket, allowing the government to take a larger percentage of their labor before the check is deposited. The individuals who break out of this cycle often bypass the traditional path. Bill Gates dropped out of Harvard to found Microsoft, amassing a fortune in his 30s that formal higher education rarely produces. Modern schooling is rooted in the industrial age, designed to train specialists, engineers, mechanics, and accountants, to function as compliant employees. It provides professional skills, but omits the training required to become an employer. This life path creates a mechanical trap, where expenses, taxes, larger homes, and lifestyle maintenance rise in lockstep with income. For the employee, the struggle remains constant regardless of the salary. Financial struggle persists even among high earners because of a total vacuum of financial literacy. Students spend years mastering history and science, but can graduate without understanding how money works, how to invest it, or the way compound interest applies to a credit card balance. Wealthy families address this gap by teaching an entirely different set of rules to their children. These lessons happen at home, centered on the mechanics of wealth rather than the pursuit of a paycheck. Without direct financial education, even brilliant professionals remain lifelong slaves to their wages. In the information age, relying on professional skills alone leaves an individual exposed to economic shifts they don't know how to navigate. Escaping the rat race requires following one specific rule. You must know the difference between an asset and a liability, and buy assets. Defined by cash flow, the distinction is simple. An asset puts money in your pocket. A liability takes money out. For a poor individual, income enters from a job and flows directly out to cover basic living expenses, rent, food, and clothes. It never touches the asset or liability columns. The middle class routes income into liabilities like mortgages and car loans, which they often mistake for assets. These liabilities then pull cash out of their pockets through the expense column. The wealthy direct their income into the asset column, purchasing stocks, real estate, and intellectual property. These assets generate their own dividends and rental income, which loop back up to create more income without additional physical labor. Living expenses are a universal reality. The divergence occurs in where a person directs their surplus cash every month. Long-term wealth is determined not by the size of a paycheck, but by the direction the earner forces that cash to flow. This divergence is clear when a professional couple receives a raise and decides to purchase a larger home. This purchase triggers a cascade of ongoing liabilities, including property taxes, mortgage interest, and maintenance. Money that could have been invested is now tied up in overhead. As the couple works harder to cover these new costs, their higher wages push them into higher tax brackets. They work more hours to pay for the house, but the government takes an increasing share of every extra hour worked. By locking their capital into a primary residence, they lose the ability to acquire income-generating assets during their most productive years. Treating a house as a primary investment ensures that expenses will always keep pace with income, turning a milestone of success into a financial burden. Building wealth requires distinguishing your profession from your business. Your profession is what you do for a paycheck. Your business is the asset column you accumulate. Ray Kroc built the McDonald's empire on this exact distinction. Kroc clarified to students that while he sold hamburgers, his business was actually real estate. The company used the franchise model to acquire the most valuable street corners in the world, building an untouchable real estate portfolio disguised as a fast food chain. The wealthy use the corporate structure as a legal vehicle to protect these assets. This framework limits personal risk and allows for a completely different method of processing money. The corporate structure changes the sequence of the cash flow. An employee earns money, is taxed immediately, and lives on what remains. A corporation earns money, pays its expenses with pre-tax dollars, and is only taxed on the profit that's left. By leveraging the legal architecture of business, the wealthy protect their cash flow, while the uninformed continue to pay the highest tax rates on their wages. Psychological barriers, specifically the fear of losing money and social cynicism, keep most people paralyzed in traditional jobs. They choose the perceived safety of a paycheck over the uncertainty of investing. In an era where inflation devalues savings and technology renders specialized skills obsolete, relying on a single employer for long-term security is a high-risk position. Clinging to outdated ideas about safety often leads to the very financial struggle people are trying to avoid. Breaking this cycle requires the discipline to pay yourself first. This means directing money into your asset column before paying creditors or the government. This strategy creates a self-imposed pressure. When the bills arrive and the asset column is already funded, you are forced to use financial intelligence to create new income streams to cover the shortfall. Escaping the rat race requires mastering internal emotions and doubts as much as mastering accounting. To change your financial future, stop focusing exclusively on the income statement. Focus instead on building and diversifying a column of true assets. Prosperity is measured not by what you earn, but by how much you keep and how hard that money works for you. Financial intelligence provides the mechanism to solve problems that a salary increase alone cannot. In a modern economy, it is the most reliable tool for achieving independence. Thank you for watching. If you found this documentary valuable, please like, share, and subscribe to Concept Corner for more.